Assalamualaikum warahmatullah. Hi, Professor Aiza. I'm Osman Safi. I'm representative from Group 1. Our group member, we have Ayu Lestari, Sofia, Izzati, Naim, Alia, and me, myself. So, we will be presenting all the answers that we have been completed for the past year's question with the steps required to answer all the respective questions. Assalamualaikum warahmatullah. Hi, Professor Aiza. I'm Osman Safi. I'm representative from Group 1. Our group member, we have Ayu Lestari, Sofia, Izzati, Naim, Alia, and me, myself. So, we will be presenting all the answers that we have been completed for the past year's question with the steps required to answer all the respective questions.
Assalamualaikum. My name is Nur Sofia binti Abdul Rahman and my metric number is 2229450. So today I will present question 1, which is focuses on account receivable management and factoring for Ehsan Berhad. The objective is to evaluate the present plan, the proposed plan, and the impact of the objective, impact of the cost, cash flow, and credit management. Let me start with the part A, which compares the present plan and the proposed plan. First, I calculate the total cost under the present plan. The company has account receivable of 4.458 million. For the financing cost is charged at 5% and bad debt are 1% of credit sale, followed by administrative cost is 50,000 ringgit. Altogether, the total cost under the present plan is 540,400 ringgit. Now, I will move on to the proposed plan. Under the proposed plan, the company reduces the average collection period to 35 days using the formula ACP divided by 360 days multiplied by annual sales. The new account receivable is 2.694 million. Next, I will explain how factoring affects financing. With factoring, the factor advances 80% of the invoice value. Interest in charge at 7% on the advance and 5% on the remaining balance. After adding both, the total financing cost is 171,646 ringgit. Besides financing, there are other costs and savings to consider. In addition, the company pays an annual factoring fee of 0.75% of annual sale. However, bad debt are reduced by 70% and administrative costs are fully saved. These changes significantly reduce overall costs. Now, let us compare both plans. When we compare both plans, the present plan costs 540,400 ringgit, while the proposed plan cost is 402,000 ringgit to 402,521 ringgit. This results in a net benefit of 137,879 ringgit, showing that proposed plan is financially better. After analyzing cost and profitability, I will now move to part B. To further support good credit management, Ehsan Berhad must also evaluate its customer effectively. For part B, the company can access potential customers using the 5 C's of credit. Starting with character, which refers to the customer willingness to pay. Capacity measure the customer's ability to repay. Capital shows the customer financing strength, followed by collateral provides security in case of default, and last but not least, condition, which is considered economy and industry factors. These factors help reduce credit risk and bad debt. Next, I will explain how these policies affect the company's cash flow throughout the cash conversion cycle. So, the cash conversion cycle measures how quickly a company converts sales into cash using the formula, which is cash conversion cycle equal to average average age of inventory plus average collection period minus average payback period. Then calculate the CCC before debt collection, which is 50 days plus 45 days minus 45 days. And the present plan is 50 days. Under the proposed plan, it is reduced to 40 days. So this means cash is recovered in 10 days up faster. So it shows there is a improving liquidity. Lastly, I will discuss the aging of receivable. So next, the aging of receivable shows the quality of credit management. From the first 30 days, it shows healthy because they pay in normal terms. Starting from the 31 to 60 days, there is a consistent late payment beyond the credit terms within 40 days. From the 61 to 90 days, a sign of weakening credit discipline which potential emerging bad debt. Over 90 days, there are high risk and may become a bad debt. Therefore, the company should strengthen control and implement proactive collection measures. My presentation with the recommendation. So I recommend we strengthen credit policy, which is set stricter credit limit and conduct credit checks before granting credit. Also, review customer payment history. Another recommendation is improve collection period, which is send early payment and impose penalties for the late payment. So
Moving on with the question 2, ABC Berhad is a well-established publicly listed company in Malaysia, operating in the consumer goods sector. Over the past decade, the company has experienced consistent growth in both revenue and profitability. It has also maintained a moderate dividend payout, aligning with its long-term goal of balancing shareholder returns with reinvestment needs for expansion and innovation. For the financial year ended 31st December 2024, the company's board of directors is reviewing its dividend policy. They are considering whether to maintain the current stable dividend policy, adopt a residual dividend policy, or implement a constant payout ratio policy. The board has asked the finance team to analyze the current financial position and advise on the most appropriate policy, taking into account investor expectation, financing needs, and market condition. ABC Berhad has the following financial data. So this question is based on the Chapter 5 for dividend policy. Based on the proposed dividend per share of RM1.20, assess whether ABC Berhad can finance its planned capital expenditure of RM50 million without issuing new equity. Support your answer with relevant calculation. So the key concept for this question is that the dividend reduces the retained earnings. Investment must be financed according to the target capital structure. If retained earnings are insufficient to cover the equity portion of capital expenditure, new equity must be issued. So how to answer the question? First, we need to calculate the total dividend, which is dividend per share times with number of shares. Find the retained earning, which is net income minus dividends. Calculate equity portion of capital expenditure, which is 60% times with the total capital expenditure. Compare the retained earning with the equity needed and conclude whether equity issue is required. Firstly, we calculate the total dividend purpose, which is RM1.20 times with 30 million shares, and we get RM36 million. And then we find the retained earnings available, which is RM60 million minus RM36 million, and we get RM24 million. And then we find the equity portion required, which is 60% times with RM50 million, and we get RM30 million. So from this, we can say that IBC cannot finance the planned capital expenditure since the retained earnings available is not enough to cover the equity portion required. Evaluate the financial feasibility of adopting a constant dividend payout ratio of 60% instead of a fixed RM1.20 per share. Calculate the new dividend per share and explain two potential benefits or two drawbacks for the company and its shareholders. So the key concept for this question is that the dividends are paid as a fixed percentage of earnings. Dividend amount changes with profit levels and provides flexibility but results in dividend variability. So how to answer the question? First, we multiply the net income by the payout ratio, which is 60%, and then we divide the total dividend by number of shares to get the dividend per share, and then we compare with the fixed dividend per share, and then we discuss the benefits and the drawbacks. So first, we calculate the constant payout ratio, which is 60% times with RM60 million, and we get 36 million. And then we find the dividend per share, which is 36 million divided by 30 million shares, and we get RM1.20. So the benefits from it is that more flexibility dividend policy. The constant payout ratio automatically adjusts dividend based on the company's earning. If profit fall, the company pay less dividend and can keep more cash for its operation or investment. So this can avoid the cash flow problems for the company. Next, the dividend payments align with the profitability. If the company generates higher profits, shareholders receive higher dividend. If profits fluctuate, it ensures dividend remain proportionate to financial performance. So for the drawbacks is that the dividend volatility may upset the investors. Since dividends move up and down with earnings, shareholder may receive less income. So the investor prefer stable dividends. When dividend reduce, investor may reduce their confidence and it affect the share price stability. Next, the company may need to reduce the dividends. A constant payout ratio may force the company to reduce dividends during years of lower profits, even when they want to maintain stable dividend payments, since dividend must be equal to percentage of earnings. Assuming the company adopts a residual dividend policy, we calculate the dividend per share and discuss the implication of this policy change for shareholders. So the key concept for this question is that the dividends are paid only after all profitable investments are financed. The retained earnings are the primary source of the equity financing. The dividend become the residual and may fluctuate widely. So, step to answer the question is that firstly, we calculate the equity needed for capex, which is 60% times with the capex. Subtract equity needed for net income, and the remaining amount equals to the total dividends, and calculate the dividend per share and payout ratio and explain the impact to the shareholders. So firstly, we calculate the equity needed for capital expenditure, which is 60% times with RM50 million, and we get RM30 million. And then the retained earning required is RM30 million. For the residual dividends, we minus the net income with the equity needed, which is RM60 million minus with RM30 million, and we get RM30 million. And then we find the dividend per share, which is RM30 million divided by 30 million shares, and we get RM1 ringgit. And then the payout ratio is that the total dividend divided by the net income, which is RM30 million divided by the RM60 million, and we get 50%. So from this, we can conclude that the dividend RM1 is lower than the proposed RM1 ringgit 20 cents. Residual policy prioritizes financing profitable investment and avoid dilution. Therefore, this increases uncertainty for investors and shareholders. Critically assess the relevance of Modigliani and Miller's dividend irrelevance theory in the context of emerging markets like Malaysia, especially where information asymmetry, signaling, and investor preference play a key role. So for the key concept for this question is that the dividend policy does not affect firm value only in perfect market. In emerging markets, market imperfections make dividend policy relevant, and the dividend act as signals and affect investor perception. So how to answer the question? Briefly explain the M&M theory, state the assumption, which is the perfect market, explain why assumptions do not hold in Malaysia, and conclude dividend policy does matter in practice. M&M is when in the perfect market, financial market, there is no taxes, no transaction costs or other market imperfections. The value of a firm is unaffected by the distribution of the dividends. In Malaysia, M&M is limited. This is due to the taxes and regulation. Tax treatment of dividends and capital gains and regulatory constraint differ across countries. If dividend tax is favorable and unfavorable, it will influence investors' preference, which contradict with M&M assumptions. Moreover, the transaction costs and financing costs are high. Borrowing money or issuing new shares is costly. Companies may prefer to keep cash inside the business. Paying too much dividend may force company to borrow more at high cost. And lastly, the investor relies so much on the dividends for income. They prefer companies that pay regular dividend since they care about dividends level. Therefore, dividend policy influences investor demands and the company's market value.
Assalamualaikum warahmatullahi wabarakatuh. So let's move on to question 3, which focuses on merger and acquisition under chapter 14. So I would like to highlight some key points in the questions. So the first point is Satria Berhad offers 1.2 of its own shares for every 1 share of the Casino Berhad. The second point is Satria Berhad has a net income of 25 million and 10 million shares outstanding, resulting in an EPS of RM2.50. Its current market per share is RM30. On the other hand, Tegas and Berhad has a net income of 8 million and 4 million shares outstanding, with an EPS of RM2. So the next point is estimated annual synergies from the merger is 5 million, and Tegas Senior Berhad has accumulated a tax loss carry forward of 12 million, and both companies are subject to a corporate rate tax of 24%. Assalamualaikum warahmatullahi wabarakatuh. My name is Ayla Savi and I will be presenting on question E from question 3 of Business Finance Set 1. Now, let's take a look at key concept first before answering this question. So, the key concept is evaluating share-for-share merger by using EPS to assess the impact on Satria Berhad shareholders. The analysis focuses on EPS changes, share dilution, and premium implied in the exchange ratio. Now, let's move on to the steps to answer the question. Firstly, determine new shares issued from the exchange ratio. Secondly, identify the premium implied in the offer. Thirdly, evaluate the impact on Satria's shareholder, either the EPS accretive or dilutive, and why. And the last one is calculate post-merger EPS. From the information extracted, Satria has net income of 25 million, 10 million shares, and EPS of RM2.50, while Tegas has net income of 8 million, 4 million shares, and EPS of RM2. Satria offers 1.2 shares of every 1 Tegas shares, which is used to assess dilution and post-merger EPS. Let's take a look at the answer. Tegas has 4 million shares and Satria offer 1.2 share for each Tegas share. This results in 4.8 million new shares issued. The total share after the merger increased to 14.8 million, causing share dilution for Satria shareholder. Let's take a look at the effect of premium implied. With Satria share price at RM30, each Tegas share is valued at RM36. This implies a higher PE for Tegas at 18 times compared to Satria's 12 times, indicating that Satria is paying a premium, which may negatively affect the existing shareholders. Now, let's move on to post-merger EPS. Combined earnings after the merger are RM33 million. Dividing this by 14.8 million shares will give post-merger EPS of RM2.23, down from RM2.50, showing that this merger is EPS dilutive for Satria Berhad shareholders.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Abdul Muzai. Now we will go through the question 3 of set 1. For part B. Okay, the question asked is for the estimate the potential tax saving from utilizing Tegas Sedia Berhad's tax loss carry forward and discuss how this saving will impact the net income of the merged company. Okay, first we identify the key concept for this question. First one is tax loss carry forward. The question asks for the past unutilized business losses that can be used to reduce future taxable income. Next is tax saving concept. The formula for the tax saving is the tax loss carry forward multiplied by the corporate tax. Next is the impact of the tax shield or tax saving on the net income. What will happen if we can lower the tax expense? From the question, we can extract that the tax loss carry forward is 12 million ringgit Malaysia and the corporate tax is 24%. Next is we calculate the potential tax saving or tax shield, which by the given formula that we can get is tax loss carry forward multiplied by the corporate tax, which is 12 million ringgit Malaysia multiplied by 24%, and we can get the 2,880,000 ringgit Malaysia. The utilization of the tax carry forward, loss carry forward will reduce the taxable income of merged company, which is Tegas Sedia Berhad, by 12 million ringgit Malaysia, resulting in reducing tax payable of ringgit Malaysia 2,880,000 ringgit Malaysia. Thus, the net income due to the merger will increase to 10,880 million. Thus, the net income due to the merger will increase to ringgit Malaysia 10,880,000 ringgit. For the next question, which is question C, is they asked for us to propose and explain 3 defensive strategies that Tegas Sedia Berhad could adopt to protect itself from a hostile takeover attempt. This question is straightforward and asks for defensive strategy against hostile takeover. And the step to answer the question is we propose a strategy which is poison pill, leverage recapitalization, and short repellents. We can then explain what these 3 strategies are, and then we can give examples or the impact on each strategies. With these answers, we can get that 3 defensive strategies that Tegas Sedia Berhad could adopt to protect itself from hostile takeover attempt is poison pill. Poison pill allows targeted company to issue securities that give holders right that becomes effective when a takeover is attempted. This dilutes the ownership stake of the hostile acquirer and significantly increase the cost of acquiring control. As a result, the takeover becomes less attractive for the acquiring company. Next, we can give for leverage recapitalization. We can explain what it is. It means that we can increase their firm's financial leverage by paying a large debt finance cash dividend. This strategy is called as leverage recapitalization. With this strategy, it can reduce free cash flow, making the company less attractive to another investor. The higher debt burden also raises the risk and cost for the hostile merger. For the short repellents, we can say that these strategies are legal and corporate governance provisions in the employment contracts of key executives that provide them with sizable compensation if the firm is taken over. For instance, we can say that supermajority voting requirements, target boards, or restriction on changes in management. This measure make it more difficult and time-consuming for an acquirer to gain control.
Assalamualaikum. In this video, I will be explaining question 4, part A and part B. For part A, I will explain the key characteristic of convertible bonds, option, and stock purchase warrant, and also highlight one key difference between a stock purchase warrant and a call option. So let us start with convertible bonds. A convertible bond is a hybrid financial instrument, meaning it has characteristic of both debt and also equity. So initially it functions like a normal bond. The investor receives a fixed interest payments, which is in this case is 4% annually, and the bond has a maturity period of 5 years. However, the bondholder has the option to convert the bond into ordinary shares of the company. So for Emirate Berhad, each bond can be converted into 160 ordinary shares at any time before maturity. From an investor perspective, convertible bonds are attractive because they provide downside protection through fixed income while still allowing participation in the company's future share price appreciation. Next, we have options, which are derivative instruments. An option gives the holder the right but not the obligation to either buy or sell shares at the predetermined price within a specific time period. So a call option gives the right to buy shares, while a put option gives the right to sell shares. So in this question, we are given a call option with a strike price of 6 ringgit and a put option with a strike price of 5 ringgit and 50 cents, both with 3-month maturity. So options are usually short-term instruments and are commonly used for speculations. So they offer high potential returns and also carry higher risk because they can expire worthless if market conditions move unfavorably. Now let's move on to stock purchase warrants. A warrant gives the holder the right to purchase new shares directly from the company at a fixed exercise price within a longer time frame. So in this case, Emirate Berhad warrant allow the holder to buy shares at 6 ringgit 20 cents and it will expire in 2 years. Unlike option, warrants are issued by the company itself, and when exercised, they lead to new shares being created, which can cause dilution of existing shareholder ownership. So warrants are usually attached to bonds or issued separately to make financing instruments more attractive to the investors. So the key difference between a stock purchase warrant and a call option lies in who issues the instruments and its impact on share capital. So a warrant is issued by the company and result in new shares being issued when exercised. But a call option is traded in the secondary market and does not affect company share capital. Now let's move on to part B, which focuses on the conversion value of the convertible bond. So the conversion value of represent the market value of shares that the investor would receive if the bond were converted immediately. So the formula is conversion value equals number of shares multiplied by current share price. So in this case, 160 shares multiplied by 6 ringgit gives a conversion value of 960 ringgit. Next, we calculate the conversion premium. The conversion premium shows how much more the investor is paying for the convertible bond compared to its immediate conversion value. So the formula is conversion premium equals bond face value minus conversion value. So 1000 minus 660 gives a conversion premium of 40 ringgit. So this means that the bond price is above its conversion value. From an investor perspective, this premium reflects the additional benefits of the convertible bond, which is regular interest income and also the flexibility to convert into shares in the future. So the investor are willing to pay a small premium in exchange for a lower risk and a potential upside.
For question 4C, the question demanded an imaginary situation where the share price will rise to certain price at 7 within certain period. Hence, the question need us to compare all the derivative, all the instrument in few situation of cost, time and potential profitability. Therefore, in the very first step, we need to identify what's the investor's objective from the target price, time frame and the goal. Of course, to maximize the profit in short term for 3 months. Secondly, we can analyze the time horizon. And thirdly, we can evaluate and compare the cost, where in the step 4, we can calculate the net profitability. From this situation, the call option profit can be calculated from the formula from expected price minus strike price and minus cost, which RM7, minus 6 and minus 55 cent, it goes to RM0.46. RM0.46. However, okay, now kita dah ada untuk call option. Second, bila kita ada untuk warrant profit, same goes with expected price, RM7 minus RM6.20, because we have different strike exercise price compared to the strike price and minus cost. So the profit goes to RM0.1, 10 cent. After we complete the calculation, then we can have the table, the summary comparison from the initial cost, exercise price and the time horizon. Finally, the potential profit. Jadi all this we can have, we can extract from the formula and from the question tadi. So the potential profit, the driving to a conclusion that the call option is a better choice, a superior choice, because first, it is cheaper. Second, the maturity match the investor timeline, 3 months. Tadi nak maximize the profit in short term compared to 2 years. And then, the profit is significantly higher. Tadi bila kita kira, we have this 46 cent rather than 10 cent of the warrant profit. Okay, call option kita akan dapat 46 cent. Okay, ni ada. For question 4D, it is clearly stated that it demands the student to answer and identify one benefit and one risk from both perspective, from the issuer and the investor. So for Emerald Berhad, for the issuer, we listed it is beneficial for them because it lowers the financial cost, where the convertible bond allow Emerald Berhad to raise fund at a lower coupon, which is 4%. Secondly, the conversion feature acts as an incentive for investor, reduce overall cost of capital compared to normal debt. And then, at lower financial cost, they compensate with the risk of dilution of ownership and control. Bila the lower cost of the issue, lower cost of the share, more ordinary shares will be issued. Therefore, the concentration of the price will be decentralized. Means shareholder will get, new buyer will get at lower price. So more shares are being purchased by the new consumer. So some of the concentration of the existing percentage of certain shareholder will be reduced. See, existing shareholders' voting power is diluted. For the perspective of the investor, the benefit will be our downside protection with upside potential. Okay, apa maksud dia kat sini ialah investor will receive the fixed coupon income. Yes, the 4% akan dapat. They will get the return of principal at maturity, typically. But if the share price rises, the investor can convert the equity and then dapat gain from capital appreciation. See, this is what they will get from the investors' benefit. However, there's a risk of expiry risk for option or warrant. Option and warrant have limited lifespan. Means janji-janji yang kita nak from beli or option yang ada dalam warrant, kalau kita tak proceed, then there's it won't benefit the investor. If share price does not exceed exercise price, okay, instrument expires worthless. yes, sudah tak berguna. You just giving the free cash to the issuer. Investor may lose 100% of initial investment. Tak ada apa-apalah, rugi.
Moving on to the set 2 of question 1. Sabah Sdn Bhd has annual sales revenue of RM15 million and all sales are on 35 days credit. Although customers on average take 10 days more than this to pay, the contribution represents 55% of sales and the company currently has bad debts of 1% of sales. Account receivable are financed by an overdraft at an annual interest of 6%. To better manage the account receivable, Sabah plans to offer an early settlement discount of 4% for payment within 10 days and to extend the maximum credit offered to 45 days. The company expects that these changes will increase annual credit sales by 5% and also leading to additional incremental cost equal to 2% of turnover. The company's bad debt is expected to reduce to 0.5% of sales. The discount is expected to be taken by 40% of customers, with the remaining customer pays within the given maximum credit period. Currently, Sabah Sdn Bhd also has an average inventory of RM1.2 million. Its receivable conversion period is always twice as long as its inventory conversion period. Sabah always pay its creditor on time, which is the net 30 days. So this question is on the chapter 2, which is the current assets management. A. Analyze and recommend whether or not Sabah Sdn Bhd should change its credit policy. So the key concept for this question is that a change in credit policy affects the sales volume, contribution margin, bad debts, receivable and financing costs, and decision should consider both profitability and liquidity. So step to answer the question is that we first need to calculate new sales after increase, calculate additional contribution, compute discount cost, bad debt savings, incremental cost, calculate old and new receivable and interest savings, add all of effects to find net benefit or loss, and recommend based on profit and liquidity. For the sales, the current sales is RM15 million, the new sales is RM15,750,000 ringgit. Which is 15 million times with 1.05. For the current ACP is 45 days. In RM 15 million times with 45 over 360 and we get RM 1,875,000. For the new ACP is that 40% times with 10 days plus 60% times with 45 days and we get 31 days. So in RM 50,750,000 times with 31 over 360 and we get RM 1,356,250,000. So the SCP decrease is 518,750,000. And then the bad debt for the current is that 1% times with 15 million and we get RM 150,000. For the new bad debt, 0.5% times with RM 15,750,000 and we get RM 78,750. And then the bad debt saving is the RM 71,250. So the discount expense is the RM 15,750,000 times with 4% times with 40% and we get RM 252,000. So for the incremental cost, 2% times with RM 15,750,000 and we get RM 315,000. And then the contribution on the additional sales is that 55% times with RM 750,000 and we get RM 412,500. Then we need to find the interest, which is the current interest is RM 1,875,000 times with 6% and we get RM 112,500. And the new interest is the RM 1,356,250 times with 6% and we get RM 81,375. And then the interest saving is 31,125. So the net profit is that RM 412,500 minus RM 252,000 minus RM 315,000 plus RM 71,250 and plus with RM 31,125, and we get minus RM 52,125. So we can say that Sabah should not change the credit policy since he will receive loss of RM 52,125 if he want to maximize the profit. Explain 3 benefits to Sabah Sdn Bhd for offering an early settlement discount to its customer. So the key concept is that discount encourage faster payment, it improve cash flow and reduce credit risk, and it has a cost that must be weighed against benefit. So how to answer the question? We need to explain the 3 benefits, which is faster cash collection, lower bad debts, and better customer relationship. So for the first benefit is that faster cash collection. The discount encourages customer to pay early, which reduces the time cash is tied up in receivable. This improves the company's cash flow and reduces the need to rely on overdrafts or short-term borrowing. Next, lower credit risk and bad debt. When customer pay early, the chance of non-payment becomes lower. This helps the company to reduce overdue accounts and bad debt expenses, thus improving overall credit quality. And lastly, better customer relationship. Giving a discount can make customers feel rewarded. It may attract more customers or keep existing ones loyal. This helps company to compete better and maintain stable sales. Compute the current and the new CCC of Sabah Sdn Bhd. So the key concept of this question is that the CCC measures how long cash is tied up in operation. Shorter CCC equals to better liquidity. CCC depends on inventory, receivable and payables period. So how to answer the question? We compute the average receivable days, which is weighted average 40% times with 10 days plus 60% times is 45 days. And then we use the rules receivable days, which is 2 times with the inventory days, and then we calculate the inventory days, CCC before and after, and compare the CCC and explain the improvement. The current ACP is 45 days, current AAI is 45 divided by 2 equals to 22.5, and we take it as 23 days, and the APP days is 30. So the CCC is that 23 plus 45 minus 30, and we get 38 days. So for the new ACP is that 40% times with 10 days plus with 60% time with 45 days. 4 plus 27 equals to 31 days. And then the AAI is 31 divided by 2, which is 15.5 days, but we take it as 16 days. And then the APP days is 30. So the new CCC is that 16 plus 31 minus 30, and we get 17 days. So the changes between the before and new ACP is 21 days.
Assalamualaikum warahmatullahi wabarakatuh. Now we are at question 2, which focuses on dividend policy under chapter 11. So it says that assume that you are recently hired by Pandaico, which is a consultant firm, which has been approached by Tawakal Sdn Bhd as a fast-growing IT company which is now ready to take the company public. Therefore, the main reason for engaging Pandai & Co is to assist the company to prepare for its first-time public offering. Mr. Salam, the lead consultant of Pandai & Co, has asked you to make a presentation to the management team of Tawakal Sdn Bhd, in which you review the theory of dividend policy and discuss the following dividend-related questions. Assalamualaikum warahmatullahi wabarakatuh. My name is Ayu Lestari and I will be presenting question 3 of set 2 Business Finance. Now, let's take a look at question A first. So this question asks us to briefly explain two dividend policy theory, namely dividend irrelevance theory and the birds in the hand theory, and to show how each theory views dividends and investor preference. Dividend relevance theory states that dividend policy does not affect the value of the firm. Proposed by Modigliani and Miller, they assume perfect capital markets with no taxes and no transaction costs. Under this theory, investors are indifferent between receiving dividends and capital gains because dividend paid will reduce share price by the same amount. Now, let's take a look at the answer. Birds in the hand theory states that investors prefer dividend received now rather than uncertain future capital gains. Proposed by Gordon and Liner, this theory argues that dividends are less risky and return earnings. As a result, the firms that pay higher dividend will be valued more highly because investors prefer certainty of income. Dividend relevance theory states that dividend policy does not affect the value of the firm. Proposed by Modigliani and Miller, they assume perfect capital markets with no taxes and no transaction costs. Under this theory, investors are indifferent between receiving dividends and capital gains because dividend paid will reduce share price by the same amount. So let's move on to part B of the question. This question asks us to discuss 3 main reasons why dividend policy is relevant in the real world. Before explaining the reasons, I will briefly mention what needs to be included in the answer. So what to include in the answer? So first, for the question, we need to first identify 3 main reasons why dividend policy matters. Second, explain each reason clearly, and thirdly, show how each reason affects shareholders or the value of the firm. So main reason, the first reason is legal constraints. In practice, laws and regulations may limit the amount of dividends a company can pay. As a result, dividend policy affects how much income shareholders actually receive. So the second reason is contractual constraints. Companies may face restrictions from loan agreements or debt covenants that limit dividend payments. This can influence shareholder returns and the company's ability to raise financing. And third reason is internal constraints. A company's cash flow and future investment plans may restrict how much dividend it can distribute. Therefore, dividend policy plays an important role in balancing shareholder income and business growth. Now, let's move on to question C. What the question is asking to us. So, the question asks us to apply residual dividend policy to Tawakal Sdn Bhd. We have to evaluate total dividend and dividend payout ratio based on given capital budget, optimal capital structure, and forecasted net profit. Next, the key concept. Under residual dividend policy, dividend paid only after the company has funded all its investment by using optimal debt and equity. So all the remaining earnings will be distributed as dividends. Now, let's take a look at the information given. Tawakal has a capital budget of 800,000 ringgit, financed by 60% equity and 40% debt, and has a forecasted net profit of 400,000 ringgit. Let's take a look at the information given. Tawakal has capital budget of 800,000 ringgit, financed by 60% equity and 40% debt, with forecasted net profit of 400,000 ringgit. Now, explaining the answer. The equity needed is 60% of 800,000 ringgit, which is 480,000 ringgit, with net profit of 600,000 ringgit. After meeting the equity requirement, the remaining amount is 120,000 ringgit, which can be paid as dividends. Finally, dividend payout ratio. Dividend payout ratio equals 120,000 ringgit divided by 600,000 ringgit, which is 20%. So next, let's look at part D, which builds on the information from part C. Previously, the net profit was forecasted at 600,000. Now, the forecasted net profit has decreased to 500,000, and we are asked to explain what will happen under the residual dividend model. So under the residual dividend model, the company first uses to finance the equity portion of its capital budget. In this case, the equity needed remains 480,000 ringgit. So, with earnings of 500,000 ringgit, after meeting the equity requirement, only 20,000 ringgit is left available for dividends. This means the total dividend paid is 20,000 ringgit, which is significantly lower than before. So, as a result, the dividend payout ratio also decreases. It is calculated as 20,000 ringgit divided by 500,000 ringgit, giving a payout ratio of 4%. This shows that when profits fall, dividends under the residual dividend model are reduced because investment needs are prioritized first. So dividends are therefore flexible and depend on the profits remaining when after financing investments. Now let's move to question E, which is the last question of question 3. So the question asks us to explain one advantage and one disadvantage of residual dividend policy. So the advantage of residual dividend policy is the firm will give priority to financing all the profitable investment opportunities. This helps a company to maintain optimal capital structure and support long-term growth, which maximizes the firm's value. The disadvantage of residual dividend policy is that dividends can be unstable. Dividend payments can fluctuate from year to year and creating uncertainty for shareholders who prefer regular and predictable dividend income.
So next for the question 3, there is tell us that Busy Sdn Bhd is considering to expand their production. The expansion will cost 400,000 ringgit, which can be financed either by bond at the interest 40% or by selling 10,000 shares of common stock at 30 ringgit per share. So there are current income statement are given before expansion. So let me see the requirement. So for the question A, we are required to calculate the degree of operating leverage, degree of financial leverage, and degree of combined leverage before expansion. First, we calculate the contribution. So what is contribution? How we calculate this contribution is sales minus variable costs. So for the sale, they are given in the statement, which is 1.5 million, and for variable cost is 450,000. So the contribution is equal to 1.050 million. Next, we calculate the degree of operating leverage. The formula is contribution divided by earning before interest tax, which is EBIT. EBIT is 500,000. Therefore, degree operating leverage equal to 1.050 divided by 500,000, which is it gives us 2.10. Then we calculate the degree of financial leverage. The formula is EBIT divided by EBIT minus interest. So the interest expense is given in the question, which is 100,000. So degree of financial leverage is equals to 500,000 divided by 400,000, which is gives us 1.25. After we calculate the DFL, we're going to calculate the DCL, which is degree combined leverage. DCL is calculated by multiplying DOL, which is degree operating leverage, and multiplying by DFL, degree financial leverage. That is 2.10 multiplied by 1.25, which is equal to 2.63. Thus, this means that 1% changes in sales will result in 2.63% changes in EPS. Therefore, the company has moderate level of operating and financial risk. So for the question B, we are required to construct the income statement under two alternative financing plans, which are bond financing and equity financing. First, we calculate the new sale after expansion. Original sales are given in statement, which is 1.5 million, and the question has tell us there is increase in sales to 1 million. So the new sale is 2.5 million. Next, we calculate the variable cost, which is 30% of sales. So 30% of 2.5 million gives variable cost of 750,000. Then we calculate EBIT, which is earning before interest tax. EBIT is sales minus variable cost minus fixed cost. So EBIT equals to 900,000. Under bond financing, the company pays interest of 156,000. Therefore, earning before tax are 744,000. After tax at 34%, earning after tax are 446,400 ringgit. While equity financing, interest expense is only 100,000 ringgit. So the earning before tax become 800,000 ringgit. After tax, earning after tax are 480,000. Next, we will calculate earning per share. For bond financing, EPS is earning after tax divided by 100,000 shares. This gives an EPS of 4.91 ringgit. For equity financing, EPS is earning after tax divided by 110 shares. This gives an EPS of 4.80 ringgit. Since bond financing result in higher EPS, the company should choose bond financing.
Okay, next we go through for the question C, question 3, question C, sub-question C. They want us to calculate the degree of operating leverage, the degree of financial leverage, and the degree of combined leverage for each financing option after expansion. Okay, first we can find the contribution margin first, which is sales minus variable cost, which then we can 2,500,000 ringgit Malaysia equals minus 30% of sale, which is 750,000 ringgit Malaysia. Then we can get from these subtracts both of these, we can get 1,750 ringgit Malaysia, 50,000 ringgit Malaysia. Then we can find next we can find EBIT, which is sales minus variable cost minus fixed cost. Then we can get 900,000 ringgit Malaysia. Then we can also find interest. So later on we can just add all this back information into the formula, which is 100 ringgit Malaysia plus 100,000 multiplied by 0.14. That, so that we can get 159 ringgit Malaysia. Then we can just put all the figure that we have just calculate into the formula of the degree of operating leverage, degree of financial leverage, so that we can find for bond financing we will find 1.944 for both financing, actually bond and stock financing. Then we find the FL. For bond we will get 1.21, and for stock financing we will get 1.13. Then for DTL we just multiply both of the DOL and the DFL for each financing, which will get 2.35 and 2.19. Okay, next we go through for the question C, question 3, question C, sub question C. They want us to calculate the degree of operating leverage, the degree of financial leverage, and the degree of combined leverage for each financing option after expansion. Okay, first we can find the contribution margin first, which is sales minus variable cost, which then we can 2,500,000 ringgit Malaysia equals minus 30% of sale, which is 750,000 ringgit Malaysia. Then we can get from these subtracts both of these, we can get 1,750 ringgit Malaysia, 50,000 ringgit Malaysia. Then we can find next we can find EBIT, which is sales minus variable cost minus fixed cost. Then we can get 900,000 ringgit Malaysia. Then we can also find interest. So later on we can just add all this back information into the formula, which is 100 ringgit Malaysia plus 100,000 multiplied by 0.14. That, so then we can get 159 ringgit Malaysia. Then we can just put all the figure that we have just calculate into the formula of the degree of operating leverage, degree of financial leverage, so that we can find for bond financing we will find 1.944 for both financing, actually bond and stock financing. Then we find the FL. For bond we will get 1.21, and for stock financing we will get 1.13. Then for DTL we just multiply both of the DOL and the DFL for each financing, which will get 2.35 and 2.19. For question D, they ask us to explain which finance plan we favor and the risk involved with each plan. So by the question and the answer that we get from the question before this, we can conclude that we choose the option 1, which is the bond financing. This because that since the bond option has a higher degree of total leverage, which is 2.35, any increase in sales will lead to a much larger percentage increase in the company's earning per shares. Okay, next we will explain the risk involved with each plan. For first, bond financing, the company faces a higher risk of insolvency because it must meet fixed interest payment of 156,000 Malaysia, regardless of sales performance. These are due to the higher leverage, which is 2.35, because the EPS will fluctuate significantly more than stock option if the sale changes. Next is the stock financing. Issuing new 10,000 shares, reducing control percentage of ownership held by the current shareholders. Okay, for the next question, for the last question for the question 3, which is sub question E, is they want us to describe Modigliani and Miller's argument in relation to capital structure and its influence on funds value. Okay, first we can say that what is the Modigliani and Miller's argument are, which is that they argue that they are under capital market conditions with no taxes. The value of the firm is independent to its capital structure. This means that debt financing or equity financing does not affect the firm's value. Okay, then we can explain that why is that capital structures does not affects the company's value. This because the investors can use their personal financing, which is which we can call it the homemade leverage, Thus, changing the firm's debt equity mix does not create additional value. Then, because of this, because of their argument is based on their unrealistic assumption, we need to introduce corporate tax to move closer the theory to real world setting. So when the corporate tax introduced, interest on debt is tax deductible, thus creating a tax shield. As a result, a firm's value increase as more debt is used. Therefore, according to Modigliani and Miller, capital structure does not affect firm value in a perfect market, but in reality, the use of debt can increase firm value due to the tax advantage.
Assalamualaikum. So in this video, I will be explaining question for part A and also question for part B. So for part A, our objective is to find the value of the company using discounted cash flow. So first, we calculate the required rate of return using Kaplan formula. So the risk-free rate is 6%, the beta is 1.2, and the market risk premium is 4%. So substituting this value gives us a cost of equity of 10.8%. Next, we discount the cash flow from year 1 to year 5 using this rate. Each cash flow is divided by 1 plus the required return raised to the power of the year. So after year 5, the cash flow are assumed to grow at a constant rate of 5%. So to capture all future cash flow beyond year 5, we calculate the terminal value and we first grow the year 5 to cash flow by 5% to get the year 6 cash flow, then divided by the difference between the discount rate and the growth rate. Finally, we discount the terminal value back to today and add it to the present value of first 5-year cash flow. So this gives us the total value of the company, which is approximately 53 to 54 million. So this represents the value of Besi, Sdn Bhd to Metal. Moving on to part B, we analyze whether exercising the warrants is profitable. So first, we calculate the initial investment. The investor buys 50 warrants at 21 ringgit each. So the total initial cost is 1,050 ringgit. So each warrant allows the purchase of 2 shares. So the investor can obtain 100 shares. To exercise the warrants, the investor must pay the exercise price of 35 ringgit per share, which gives an additional cost of 3,500 ringgit. Next, we calculate the market value of the shares obtained. At a share price of 40 ringgit, the 100 shares are worth 4,000 ringgit. So to find the profit or loss, we subtract the total cost, which includes both the warrant cost and also the exercise cost from the value of the shares. So this result in a loss of 5,000. This will
For question part C, required A, the existing status quo or condition is quite direct and simple, where a company ada convertible bond and the bond outstanding are callable at 1,200 ringgit. Convertible to 25 ordinary share, and it is currently selling at 40 ringgit per share. So all the information are there. What the student need to do is to calculate the conversion and the conversion price based on the conversion ratio times the current share price, which is 25 shares, you time by 40 ringgit. So it turn to RM1000. Here, after you calculate, what you need to do is to compare and conclude the action. So the bondholder will likely allow bond to be called and accept the payment at 1,200 because the call price is higher, 1,200, than the conversion value. So if they convert, they would only receive share worth RM1000, resulting an immediate loss of 200 compared to cash call. Dia akan rugi. Question 4B. The question state for another assumption where instead of the call feature, the company has the right to drop the conversion ratio from 25 down to 20 after 5 years and down to 17 after 10, the certain period. If the bond have been outstanding for 4 years and 11 months, okay, ni dia nak bagi tahu 4 years and 11 months ni, it is not sampai 5 years, macam tu. What will be the price of the bond if the share price is RM41? So what we need to do is to determine the applicable conversion ratio. Maksudnya within 5 years, it drops from 25 to 20. The ratio remains 25 lah, because tak sampai lagi 5 years. So we can calculate the bond price using the formula of conversion ratio time share price. So RM25 times with RM41 equals to RM1,025. There is another assumption in question C. Assume that the share price is anticipated to rise to RM43.75. Tadi berapa tadi? 41. So what we need to do is to evaluate the convert now option. First, value asal tadi, if within the 5 years or initial value is at RM41 times 25 is 1,025. However, in the timing after for the 3 months tadi, because it correlate with the required B lah. Tadi 4 years 11 months. Now you tambah 3 months, it's 5 years and 1 month. So ratio already dropped to 20 from 25. So by using the same formula but different ratio and different price, now 20 darab dengan 43.75 rather than darab dengan 41. Okay. So the question also asks for the recommendation. Bila nak ada recommendation, you have to compare and contrast. If ada lah. So the first thing dalam comparison, we must check the differences lah. The difference is value asal, which is 1,025, bila dengan ratio 25 you darab 41, tolakkan dengan value yang kedua, which is 20, you darab dengan price yang bertambah 43.75. So 1,025 minus RM875, kalau the share being whole, dia akan kerugian sebanyak RM150. So, the bondholders should convert now. Walaupun price naik, tapi ada assume as a penalty lah, because ada ratio dropping from 25 tadi ke 20. Nampak je harga naik, tak semestinya the value will be naik. Tengok juga dia punya counterpart of the price, of the ratio. Tadi 25 turun ke 20.